But in case it gets to be too much, just let me know. It's really nice here. Does anybody have any questions? Anything they would like to go over? I told Terry that your confirmations, it's called a passport, probably will not come till like the week of the 12th, give or take. So as you get them, people usually let me know, and then I'll check with everybody when we come in here. So is there anything that anybody needs clarification, anything they need to discuss? Where did you put in for your first one? So you want to go to New York rather than New Jersey? Where were you going in New York? Okay. I've actually never been asked that question, so you'll have to tell me how this works. Call headquarters and tell them and see what they say. You shouldn't have a problem because I believe that's where Althea is also going. Where was it in New Jersey? Where are you coming from again, Barbara? Yeah, my suggestion is you call headquarters tomorrow or send them a message. Either one you can do, because you could do it tonight, send them a message. Yeah, and just let me know what they say so that if anybody ever asks. Hi, Cassandra. Then I'll have that answer also. I would think that they could switch you without a problem. But I don't know for sure. But that's a good one. That's something else I have to put in my little repertoire of stuff that I know of. Yeah, thanks. I'm hoping that they can get it online pretty soon, so you guys can just go to somewhere a lot closer, but we'll have to see how that works. Hi, Lucretia. Okay, so we're in session 16. This is Unit 7, Chapter 1 is what we'll be doing tonight. Next session is 3 October, which is Thursday. We're going to do Unit 7, Chapters 2 through 4, and then the Unit 7 quiz. Okay, so Unit 7 is financial functions. No panicking, we're going to be okay. And what this will be is issues related to budgeting and financial statements, general issues related to budgeting and financial statements. That should be pretty much what we're doing tonight. The cash and banking transactions, the making of various types of journal entries, and the reconciling of electronic funds transfer and bank statements. So Chapter 1 has 26 objectives. Budgets. Budgets outline how resources are obtained and expanded over a projected time period. Budgeting is closely related to financial forecasting. After budgeting has taken place, financial statements projected into the future can be prepared. This is part of the financial forecasting aspect of accounting. Budgets are critical to the coordination, implementation, and control of a business plan. They are important in proper management of both personal and business resources. An operating budget outlines anticipated revenues and expenses for a period of time. A financial budget projects cash flows in and out for a period-ending balance sheet. Capital expenditures budgets plan for major purchases, such as purchases including plants as in the place where you work, warehouse, equipment, property, and long-term assets are included in capital expenditures budgeting. Budgets developed and managed on both macro and micro levels in business. Businesses generally develop budgets by areas such as sales, purchasing, inventory, etc., and by department or business reporting unit. Master budgets detail all financial planning areas of a business. The income statement is projected from budgets prepared by sales, production, raw materials, direct labor, overhead, and operating expense areas. The balance sheet may be prepared after the cash and capital expenditures budget have been prepared. The budget is prepared by accounting period in an organized, systematic way. First, the forecast for sales must be determined. The volume of production output plus costs and expenses must be projected. The flow of cash and financial effects, such as taxes, must be ascertained. Budgets are prepared and forecasted, and then financial statements can be forecast. Each budget is organized using the proper budget format of the area. Flexible budgets are prepared by the managerial accountant to help the accountant see total costs or revenues incurred in a range of production units presented. So, for example, the ABC car company prepares a budget for the production of 10,000, 15,000, 20,000 cars. The actual number of cars budgeted for production may be 15,000. This type of budget shows a comparison between the various levels of production projected. The flexible budget is aimed toward a range of activity rather than one activity. The static budget is geared to a single level of activity only. The static budget compares budgeted amounts to actual costs and then shows the difference between the two amounts. This difference is also known as the variance. So mine's on page 211. Not sure where yours is. This is an example of a variable budget. In the preparation of each individual budget, the accountant must consider each area of data needed to compile the budget, including the following major areas of concern for the various individual budgets to be compiled. Fixed and variable costs in maintenance, production requirements, and desired level of inventory and raw materials, the number of items to be produced to fill sales requirements in the sales budget, items needed in plant, machinery, and equipment areas for the capital expenditure budget, cash receipts, disbursements, and balances in the cash budget. Budget variations. The variation factor is the difference between the fixed costs and budgeted fixed costs. If the actual cost amount exceeds the budgeted cost amount, the variance balance is said to be unfavorable, because it would be negative, so unfavorable, by the amount difference between the two. So if the cost of equipment is budgeted at $90,000 and the actual cost is $100,000, the variance is unfavorable by $10,000. If the budgeted amount exceeds the actual cost, then it's favorable. It's plus. These differences may be stated also as variances between standard and actual costs. Standard costs represent the per unit production cost of operation under the best circumstances. Assumptions of accounting. Accounting is the process in which financial data is brought together in an organized manner through recording, classifying, reporting, analyzing, and interpreting activities. This module on accounting principles will attempt to cover basic accounting fundamentals, theory, and terminology. Following assumptions are basic to accounting theory. The accounting entity concept. We assume that every organizational entity is accounted for separately or individually. Every business should keep separate books. The continuity or going concern concept. Generally, it is assumed that a business lifespan will continue on indefinitely or for at least 1 year. The accounting period or periodicity concept. Reports are usually issued on an annual basis. Financial data can also be issued monthly and quarterly on a periodic basis. The unit of measure concept. The basic, most commonly used measure of money is adopted by accounting as the standard unit of measure in the United States, Canada, Jamaica, and other nations. The dollar is used as a unit of measure. Of course, there are many other standard measures of money throughout the world. The constant dollar method of measuring income. This was used commonly in the early 1980s when inflation distorted financial statements, accounts for changes in the general price level. Costs of non-monetary assets, some liability and owner equity amounts are increased or decreased based on the movement upward or downward in the economy-wide index, such as the Consumer Price Index, CPI of the United States or Canada. Current, generally accepted accounting principles, GAAP, states that transactions should be recorded at historical costs. Other principles basic to accounting include conservatism, materiality, consistency, objectivity, the revenue principle, and the matching principle. So we're going to go over these now. So conservatism. The principle of conservatism states that the accountant will be conservative in the measurement of financial data, thus understating rather than overstating organizational income and assets. Conservatism only applies when there are several alternatives, all of which are generally accepted. Materiality. The accountant will generally only consider recording transactions of material or significant costs. Items of low cost or insignificance, such as pencils and small office supplies, are generally expenses, and they must be accounted for as a group, not as individual units. Consistency. Accounting reports and records should be prepared in a similar and consistent fashion as previous reports, unless the accountant otherwise makes a footnote disclosure to the financial statements and the reason for the change. Objectivity. Transactions recorded in accounting should be supplemented by objective, variable evidence free from bias. Objective, verifiable evidence free from bias. Full and complete disclosure. In order to not mislead the reader, financial reports must contain information clarifying items contained in the report. Pertinent information must be disclosed and not excluded from the report. Cost principle. Cost represents the money or resources foregone in order to obtain other goods and services. Costs should initially be recorded at the historic amount. The amount recorded is the cost of the resources foregone or given up. Revenue principle. Generally, revenues are recognized in the period when products are sold or services are rendered. This is accrual accounting as opposed to cash-based accounting, in which revenues are recognized when cash is received. Matching principle. Expenses must be matched with revenues incurred. Some costs may have been incurred in a period other than the one in which the revenue was received. As revenues and expenses are properly matched, the net income for the firm is correctly obtained for each revenue period. Other important accounting concepts worth mentioning are the principle of duality and the concept of accrual accounting. The principle of duality. In accounting, each transaction has a dual effect. Both sides of the T account in a transaction must be accounted for. This concept requires that debts must equal credits for each transaction that has occurred. Debts and credits are only sides of a T account. Accrual accounting. The accountant records financial data as the obligation occurs, rather than waiting for receipts to be made or cash exchange to take place. Most companies must use accrual-based accrual basis accounting that results in a more accurate representation of net income. Assets. Assets and other topics as they're related to accounting theory and classification of accounts. Assets are resources of an organization that can be assigned a monetary value. They can be tangible in nature, such as your land, buildings, and machineries, but they can also be intangible, such as patents, copyrights, goodwill, or accounts receivable. Assets are generally listed on the balance sheet in three categories. Current assets, non-current assets, and intangible assets. So current assets, cash and other assets that are expected to be converted into cash, sold, or consumed either within 1 year or the normal operating cycle, whichever is longer. Your non-current assets, they're the land, the building, and equipment. And then the intangibles, the copyrights, trademarks, goodwill, patents. Contra revenue accounts offset revenue accounts. Sales returns and allowances may be used as a contra revenue account. In Canada, contra liability accounts offset liability accounts. An account discount on bonds payable can be used to record an amortized discount on a bond. Liabilities. These are obligations to creditors incurred by the organization requiring payment in money, goods, or services sometime in the future. Liabilities may be current or long-term. So current liabilities include any debts due within the current year or accounting period. Current assets are generally used to meet these obligations, including accounts payable, notes payable, accrued interest, and taxes payable. Long-term liabilities include mortgages payable and other obligations due after a period of 1 year, such as the long-term notes payable and bonds payable. As these debts become due within a year, they are reclassified as current liabilities. So we have the accounting equation. Assets equal liabilities plus owner's equity. The equation, assets equals liabilities plus owner equity, is well known to students of accounting. The phrase is known as the accounting equation. This equation serves as the basis for the balance sheet, which is a statement containing asset, liability, and owner's equity accounts. So you can list this in many ways. We have assets equal liabilities plus capital or equity. You can have assets less liabilities equals capital. And total current assets less total current liabilities equals working capital. Debits equal credits. Debits are always the left side of the T account. Credits are the right. So forget about your checkbook, because some debits will be pluses, some will be minuses. It depends where it goes. So the thing to remember is debits, left side, credit, right side. In assets, if you have a debit, it's an increase, a credit's a decrease. Your assets and expenses. Your liabilities, capital, and income, the debit side, left side, is decreases, the credit side, right side, is increases. So double entry accounting requires that the left side entry on each asset, liability, and owner's equity account be equal, as we mentioned in the duality principle. To increase a liability, you credit the right side of the entry, the account. In every transaction, the debits, left side of the T account, must equal the credits. Which is the right side of the T account. So, for example, if you sold a pair of shoes for $100, this is how you would do it. You debit cash, left side of the T account, and credit sales revenue, the right side of the T account. So this is what the entry would look like. So in essence, both of them are going up. To decrease a liability account, you debit, left side of the T account, the account. Put another way, liabilities are increased by crediting, right side, and decreased by debiting, left side. When recording an asset on a T account in double entry accounting, the administrative professional or accountant can increase an asset by entering the amount on the left side, the debit side, of the asset account. The asset account is decreased by entering the amount on the right side, the credit side of the account. Contra account asset accounts offset or reduce the related asset account. They are increased by crediting right side of the T account, and they're reduced by debiting right side of the T account. Owners or stockholders' equity. Owners or stockholders' equity is also called capital, proprietorship, and net worth. This equality is equal to the company's owners or stockholders' claim to company assets after dividends are paid and after creditors' claims on company assets. Sources of owners' equity include contributed capital, which represents the funds and resources contributed to the business by its owners, including common and preferred stock outstanding and retained earnings. Retained earnings include all business profits made and retained within the firm, less losses and dividend payments. Retained earnings are determined by the use of the following formula. Net income equals revenues less expenses. Current retained earnings are retained earnings accumulated up to the beginning of the current period plus net income less dividends. Owner's equity account entries are made in the same manner as liability accounts. A debit to the owner's equity account will decrease because it's the left side of the T account. A credit to the owner's equity account will increase, right side, so credit. Revenue, expense, and income. Revenue may be called the amount received from an organizational client or customers for goods or services rendered. Revenue is earned when the company completes the activity on which the transaction is based. So some revenue and examples include funds earned from rent, services rendered, and interest. Revenue is realized and recorded when the sale is made or when the service takes place. Expenses are outflows of resources or costs incurred by the firm while striving to gain revenue. Expenses represent the use of services or goods or the depreciation of assets. Expenses are recorded in the period they are incurred. Expenses include things such as salaries, taxes, rent, utilities, supplies used, interest, advertising, and depreciation. So when revenues are debited, which is the left side of the T account, they are decreased. When revenues are credited, right side of the T account, they are increased. In contrast, expenses are increased by debiting, left side of the T account, and decreased by crediting, right side of the T account. The difference between revenues and expenses results in a net profit or loss for the company. Income from operations can be computed by subtracting operating and general expenses from operations revenues. Net income is then determined by adding other non-operations income such as rental income and by subtracting other non-operating expenses. Financial statements. Financial statements are reports showing the financial status of an organization or individual. They report on assets, liabilities, and business ownership, the relationship between income and expenses, profit or loss, and they show where cash is flowing, comparing operating, investing, and financial activities during a given period of time. So the four primary financial statements used by the organization. You've got the income statement, which is also called the statement of earnings and statement of operations. The balance sheet, which is also called the statement of financial position, the statement of cash flows, and the statement of owner's equity. So we're going to start with the income statement. This is also called the operating statement. Shows net income or loss for a particular accounting period. It lists the company name, the words income statement or operating statement, for the period ended, and the date is listed. All forms of revenue are shown on the income statement. The cost of goods sold and manufactured is given. So the income statement is summarized as follows. Revenue less cost of goods sold equals gross margin on sales. The gross margin on sales less the expenses equals operating income. The operating income less other expenses and taxes equals net income. So here is an example of an income statement. Comparing each account with various prior years, the accountant can check for significant changes in the accounts. Each item or major category may also be computed as a percentage of net sales and then compared as a percentage with previous years. So this one shows 2007 and 2008. The total revenue went down, their total income went down, and their total expenses went down, and their operating result went down. Or up, sorry. 2006 on the, everything went up. I'm sorry, I looked at it backwards. So the balance sheet. This is also known as the statement of financial position. It shows how assets equal liabilities plus owner's equity. The accounting equation. So the balance sheet can be summarized as follows. The assets, you have current assets, cash, receivables, inventory, prepaid expenses. Then you add property, plant, and equipment at cost. Then you subtract accumulated depreciation and amortization, and this equals your total assets. Liabilities and stockholders' investment, you take current liabilities, accounts payable, reserve for returns, accrued liabilities, etc. You add long-term debt, you add deferred income taxes, you add the shareholders' investment, stock and retained earnings, and this equals total liabilities. So your total assets equal total liabilities and stockholders' investment, the accounting equation. Analysis of the balance sheet and other financial statements is facilitated by the consistency principle. From year to year, the accountant uses the same method of recording and presenting financial data so that financial comparisons and trends can be analyzed. Of course, the accountant always notes any changes in procedure in the statement according to the full disclosure principle. Analysis of the balance sheet helps one see how a company stands in terms of assets, liabilities, and owner's equity. An increase in receivables may indicate higher sales or less effectiveness in making collections. Liquidity of the business can be found by use of the balance sheet as well as its working capital. The balance sheet lists current and long-term assets, other assets including intangibles, current and long-term indebtedness, and owner's equity in the firm. The balance sheet is dated at the end of the period because the date included are listed in amounts on a particular date. The other statements show information for a period of time. So here is a copy of a balance sheet. You have the assets, and this one has it broken down into non-current and current. There's your total assets. And if you see what they did, they put the non-current assets total up there. Some people put it at the bottom. Then the equity and liabilities, you have the owner's equity. Then you have the non-current liabilities, current liabilities. So you see the total equity and liabilities equals the total assets. statement of cash flows, also referred to the statement of changes of financial position. The statement of cash flows has been given other names, including the fund change statement, funds of flow statement, the statement of changes in working capital, and the statement of source and application of funds. Working capital is equal to current assets less current liabilities. This statement shows the change, increase, or decrease in working capital in a given accounting period. The term funds refers to cash, generally speaking, as in the case of petty cash or bank funds. So basically, the statement of cash flows includes inflows and outflows from three activities. That's operating, investing, and financing. In other words, financial data is put together in statements and summary forms for managerial decision-making purposes, current and potential investors, the use of current and potential creditors. So a summary of a statement of cash flows for a given period of time, which is usually 1 year. So you have the cash flows from the operating activity, because remember, it's operating, investing, financing. So you have the cash flows from the operating activities. You have the receipts minus the payments. This equals your net cash inflow or outflow from operations. So in the investing ones, you have the assets used for investments, you add the loans or other investments that you made, you subtract the proceeds from the sale of assets, and this equals the net cash flow the net cash outflow or inflow from investing activities. And then you have the cash flows from the financing activities. And this is your proceeds from your stock issuance. You add your proceeds from issuance of long-term debt, you subtract the payment of long-term debt, you subtract the payment of dividends, and you have the net cash inflow or outflow from the financing activities. So add all cash flows to obtain a net increase or decrease in cash. Show the cash balance as of 1 year before statement issuance. Show the cash balance as of December 31st, the date of statement issuance. So here's an example of a cash flow statement. And you see you have the operations, then you have the investing, and then you have the financing. Statement of owner's equity. The owner's equity statement is summarized as follows. You have the owner's capital or equity as of a specific date. Then you add the net income from the accounting period minus withdrawals that the owners might have made. The owner's equity is equivalent to an owner's claim to assets of a firm after claims of debtors. So we'll discuss this third-party balance sheet equation. Assets equals liabilities plus owner's equity. We'll now consider accounting for owner's equity in each of the following types of profit-seeking business organizations: the sole proprietorship, the partnership, and the corporation. So here's a statement of owner's equity. So the sole proprietorship and the partnership. Corporations must differentiate between the owner's investment or contributed capital and retained earnings. However, proprietorships and partnerships are not required to make this distinction. For the sole proprietorship, owner's equity may be simply stated as owner's capital. Capital is outlined by first listing capital as of the beginning of the period, Net income of the period less withdrawals is listed. This leaves the amount of capital at the end of the period. The partnership owner's equity section of the balance sheet is handled similarly, listing the capital of each individual and total partner equity. The statement of partner capital lists the capital of each partner, increases to and decreases from the equity of each partner, and the period and equity amount for each partner. Capital stock. The corporate report of owner's equity is more complex than the sole proprietorship or the partnership report. Capital stock is equivalent to owner's equity in a corporation. We will consider preferred and common stock, treasury stock, and related material. Holders of capital stock own the corporation. Stockholders have the right to be listed as a stockholder with the corporation. They also have the following stockholder rights. They have the right to have stock issued in their name, to vote or assign a proxy to vote on their behalf of the stockholders meeting, 1 vote per share, to share in dividends issued by the company, to examine financial records upon advance notice to the company, and to receive a financial report on the status of the company on a regular basis. In addition, each stockholder has the right to keep a proportionate share of their interest in the business. If the corporation dissolves, common stockholders have the right, after creditors and preferred stockholders, to receive the balance of liquidated corporate assets. They also have the right to sell their interest in the company to others and to authorize the purchase of fixed assets. So common and preferred stock defined. Common and preferred stock are forms of capital stock issued to stockholders of a company. Common stockholders legally control the corporation. Common stockholders take greater risk than preferred stockholders, but they stand to make greater gain in case of successful profit-making operations. This is true because in cases of dividend issuance, preferred stockholders receive a set dividend payment, while common stockholders receive the entire balance beyond the payment to preferred stockholders. If that balance is very substantial, the common stockholder could benefit considerably. Conversely, if the profit remaining after distributions to preferred stockholders is small, common stockholders will not necessarily benefit. Classes of common stocks, such as Class A and B, are issued to differentiate between specific rights and allowances stockholders may have. Preferred stockholders generally do not have the right to vote for the board of directors. However, they may have the right if the company so specifies. Preferred stock has specific characteristics distinguishing it from common stock. Preferred stockholders listed are issued a particular amount of dividends before common stockholders, as we've already mentioned. This preferred dividend, based on a percentage of stock value, par or non-par, is payable to stockholders only if the dividend is declared by the firm. Usually preferred stock dividends are cumulative, meaning that they accumulate over time. If a dividend is missed, the preferred stockholder is entitled to unpaid prior dividend amounts. Cumulative dividends must be paid before any common stock dividends are paid. If the preferred stock is classified as participating, its owners participate in corporate profit distribution beyond preferred dividends. Stock is similar to bonds when considering its convertibility or its callability. The par value of stock is the face value or lowest value the corporation will accept in its first issuance. Par values generally does not represent the real value of the stock. Non-par value stock was established to help avoid misleading people who believe that the par value stock is the true value of the stock. Often, however, laws provide that non-par stock is issued at stated value. Stock may be interpreted in terms of market value and book value. Market value is the price of stock purchase or sale at a given time on the market. Of course, the stock market is in constant fluctuation, and this value is continually changing. The book value or equity value per share is found by determining the dollar amount in stockholders' equity, or the dollars invested in shares outstanding, divided by the number of shares outstanding. The book value is the amount of which the common stock was originally sold. When stock is issued at par for cash, cash is debited, left side of the T account, and the stock account or accounts are credited, right side of the T account. When stock is issued for items other than cash, the non-cash items are debited, left side of the T account, and the stock accounts are credited, right side of the T account. The same recording procedure is used for non-par stock. When stock is recorded in the owner's equity section of the balance sheet, it is listed at book value. Market value may be added parenthetically for reference. When one subscribes to shares of stock, they're promising to pay the stock in full at some future date. Stock subscriptions are counted as assets. When sold at a premium for more than par value, stock sale is recorded by debiting, left side of the T account, the cash account premium, and stock accounts are credited, right side of the T account. For all practical purposes, stock is never sold below par or discounted. Here's an example of recording the issuance of stock at par value and stock at a price other than par. Okay, mine's on page 223, so I don't know what page yours is on. So dividends. Dividends are announced on the declaration date by the corporation. On this date, the recording entry for dividends payable is made. The recording date is given on the declaration day, as well as the payment date. The recording date falls after declaration. Those holding stock on the record date are sent the dividend on the payment date. Dividends are paid in cash or in additional stock, or a combination of cash and additional stock. Two important basic entry recordings for dividend payments include 1. The recording of the declaration of dividends, and 2. The recording of dividend payments. The declaration may be recorded by debiting, left side of the T account, the dividends account, and crediting, right side of the T account, the dividends payable account. This entry will lower ending retained earnings when the statement of retained earnings is prepared. To record the actual dividend payment, the liability account dividends paid is decreased or debited, left side of the T account, and the asset account cash is decreased or credited, right side of the T account. When issuing stock as a dividend, at the time stock is distributed, the liability account for stocks to be issued is decreased or debited, left side of the T account, and the common stock account is increased or credited, the right side of the T account. The stock split. When stock is split, the value of the stock declines per share, but the investor receives enough extra shares to leave their investment the same as it was prior to the split. The main objective to a stock split is to bring the stock price down. Since many investors buy in 100-share lots, a split could bring stock prices into the reach of a wider range of potential investors. Treasury stock. Treasury stock is stock that has been issued by a corporation and subsequently bought back by the company. Treasury stock is not an asset because a corporation by law cannot own itself in part or whole. Corporate purchase of its own stock simply returns capital to stockholders of the firm. There are a number of reasons why corporations buy back their own. So, for example, a corporation may desire to make additional stock available to its employees or executives. Funds on payment of dividends can be saved by the company, and companies desiring to take over the corporation through stock purchases can be discouraged. The recording of treasury stock purchased by a firm is: the treasury stock account is debited, left side of the T account. The cash account is credited right side of the T account. On the balance sheet, treasury stock is subtracted from the stockholders' equity section. In effect, it is a contra stockholders' equity account. Markets for securities. Primary markets such as the New York Stock Exchange and the American Stock Exchange in the United States are initial sales points for major sellers of stocks and bonds. Secondary markets trade these items. Over-the-counter markets engage in buying and selling stock and bonds not involved in the major stock exchanges. Unlisted securities are traded in over-the-counter markets. The Security and Exchange Commission, the SEC. It's a regulatory agency established by the United States Congress for the public's protection. It regulates the issue, buying, and selling of stocks in the U.S. The administrative professional may want to be familiar with procedures for recording stock market transactions and should know how this recording is interpreted. The Wall Street Journal lists major stock market transactions every working day. Each company named listed on the stock exchange is printed in alphabetical order on the stock market transaction page, along with a series of numbers following the company name. So the features listed on the stock market transaction page include, from left to right, the highest and lowest stock sales prices during the year, company name abbreviated, the recent rate of dividend payment per share, the percentage yield, price per earning ratio, number of shares traded in thousands during the day, high and low trading prices and closing price of the day, the net change from the previous day closing price. Prices are listed by a minimum fraction of 1/8 of $1. Margin trading and short selling. Two selling terms often used in securities markets are margin trading and short selling. Margin trading refers to buying securities on credit. For example, the margin requirement is 50%. The investor must pay 50% down on the stock and borrow the remaining money. Short selling takes place when a person obtains securities not owned by the seller on the assumption the price will drop at some time in the future and the person can record a profit. If, however, the price of the stock later goes up instead of down, the person making the future purchase will sustain a loss because they will have to pay more for the stock. Therefore, short selling is based on the assumption that a particular stock price per share will go down. Over-the-counter markets deal in the buying and selling of stocks that are not carried on the major exchanges. Brokers and dealers assist in these sales of corporate stocks in numerous locations. They also deal in stock transactions on the exchanges. Most bond transactions occur in over-the-counter OTC markets. New securities and a significant dollar value of stock exchanges also occur in OTC over-the-counter markets. Retained earnings. These are funds kept within a corporation without being paid out as dividends to stockholders. They equal profits of a firm since its origination, less dividends, losses, or transfers to contributed capital, assets which are invested by the stockholders. Such earnings may be either appropriated or unappropriated for specific uses. So appropriated retained earnings are established and set aside to be kept in the company. Appropriated retained earnings are not paid out as dividends. These designated funds may be retained in the company by choice or by an established contract requirement. The case of company issuance of bonds or long-term notes may fill this circumstance. The firm may desire or choose to allocate funds for a particular capital project in the company. Some states in the United States require money to be appropriated equal to the investment of the company in treasury stock. Unappropriated retained earnings are those earnings that have not been set aside for uses other than reinvestment or contractual savings obligations. Dividends may be paid from unappropriated retained earnings. Income taxes, gains, and losses. The income tax was first enacted in the United States in 1913. Due to the time value of money, organizations prefer to shift their general tax liability to later tax periods. Individuals can postpone taxes through certain investments and other activities as well. IRAs, individual retirement accounts, or annuities, in the United States are utilized to postpone taxes. They also serve as a savings incentive and add to retirement income security. Sometimes, some time will now be taken to determine what constitutes income in the case of individual tax returns versus corporate tax returns. So gross income equals income from every source, deducting exclusions allowed by current tax law. Taxable income equals gross income less deductions, standard or itemized. Deductions from gross income vary from country to country. It is very important that each citizen be in touch with current tax law to know what does and does not apply. Exemptions are allowed in the United States as currently outlined by the Internal Revenue Service, IRS, including personal and dependent exemptions. Check with the IRS, Internal Revenue Service, the Canadian Revenue Agency, or other national entity in your nation of taxation for the current laws and details. Gains and losses assigned to capital, stock, and bond assets sold or traded can have impact on income taxation. Short-term capital assets have been held by the entity for less than a year, while long-term capital assets have been held over a year. Net gains or losses on the assets are computed by taking the difference between the net short-term and net long-term gains or losses. Comparative statements. Comparative statements. Balance sheets, income statements, retained earnings statements compared. List the entire statement for 2 or more consecutive years. It is up to the accountant to determine if the increase or decrease from one year to the next in each account listed is shown, along with the percentage change from one period to the next. This is, of course, the concept of comparative analysis. Firm profitability, stability, and liquidity are analyzed by use of comparative statements. When comparisons are made over a period of years, trend analysis occurs. Trend analysis shows patterns that are helpful in forecasting and budgeting. In comparative statement analysis, horizontal and vertical comparisons are analyzed by the accountant. Horizontal analysis constitutes the comparison of amounts and percentages for a particular item or account over a period of 2 or more years. Vertical analysis shows percentage and total comparison for 2 or more years in vertical columns on a single sheet. Statements referred to as common-size statements show comparisons in a related way. For example, the cost of goods sold for one corporation as a percentage of sales may be less than the same percentage for another business. Retained earnings statement. The retained earnings statement itself is an analysis of appropriated and unappropriated earnings retained in the company. This statement utilizes the following basic format. First, retained earnings from the beginning of the period are listed. The net income of the year is added to the beginning year retained earnings. Dividend payments are then subtracted from the subtotal, leaving the retained earnings figure for the year end. Occasionally, the income and retained earnings statements are combined, making one financial statement of 2. Okay, that's the end of the presentation for tonight. Do we have any questions? Anything? That's why a lot of people have an accountant, Doris. Not the easiest thing in the world sometimes to understand. Well, Roxanne, you got the best of the worlds, don't you? Oh, Angela, I understand. I totally understand. I actually get to work a few days, but only a few. I have payroll to do.